Over, we lost sound. All right, we should be back and running here again, folks. Sorry, this is like amateur hour. We've had our previous show really done. We tried to put some new screens together, and it's just not coming together. So, so what we're talking about here and what Mitch is going with as we go through these slides, and he was just trying to keep from laughing because I was changing screens all over while he was talking. So. It was kind of funny. I'm sorry. We apologize for this amateur approach that we're doing today. But I talked about this SOS that we keep talking about, and SOS stands for Suggested Operating Structure. So it's about getting all the assets under one roof, having control so that you can start to shoot and blast orders out to everything to make this thing authenticate in an appropriate way, and those are probably the key elements. And at least having a sense, you'd want to do your practice better than we're running this show today for sure. But I guess we have to make fun of this. I'm not. A couple things got messed up about 4 minutes before the show came on, and it's just a nightmare over here at the moment. But yeah, so this suggested structure is really what we're doing is trying to come up with some basic concepts of you getting the business completely scalable. So the next thing, I like the tap to add text part here.
Yes.
The reason why it's doing that is because I can't run the full PowerPoint because it's cutting off on the resolution and what we're able to display on the channel. So you'll have to look at the center section here. Mitch, can you read that well enough?
Yeah.
Okay.
Yep. So it is. It's like on a trapeze without a net and making sausage in real time with people. So, so with this slide, I just gave you that are watching this an example of at the end of an audit, an internal audit, this fact-finding process where you're going through. You should be able to have this type of insight into your own book of business. This is completely made up, of course, but when I was running money out there, just like you guys, I had this type of information at my fingertips on a daily basis. So I knew exactly where the accounts were located, how many accounts were in these strategies, and actually I would be able to drill down further and be able to see, all right, at a particular custodian, what are the strategies that we have there? What are the portfolios, the models? What assets are in those models? And depending on what information I was seeking out at that time, I would dig down further and further into that information, depending on what the task was that I was dealing with at the time. So you should have this type of clarity in place throughout your practice. And again, it's the suggested operating structure. And if you don't have this type of framework in place, it's going to become very difficult, if not impossible, to effectively run your practice in a scalable fashion. At any point, you should be able to pull up each of the different strategies that you have within your practice, know how many assets are in a particular strategy, how many accounts are there, and if you need to turn on a dime for whatever reason, if you have orders that need to be executed because it's a Monday and there's been some movement that day, or if you're going through an audit and the auditor is wanting to know some information, this is information that it's incredibly important to be able to have this right at your fingertips. Because time really is money. How it is, how long it takes to be able to process trades and validate those trades is important to make sure you're executing the responsibility properly for your clients. If you're going through an audit, believe me, the auditors will remember how long it takes for you to find information. If they feel like they've waited too long to get something that they feel is something that they should have right at their fingertips, they're only going to ask more questions because they want to understand why it is that an audit's being particularly difficult.
Well, let's talk about something other than audits.
Yeah.
That sounds depressing. I hate audits. So let's go ahead and talk about some of the ideal framework that we have here, because I think that's also important. And most of you that we meet are pretty familiar with mutual funds, obviously, for the past whatever amount of years, and now that ETFs are becoming more prevalent, the use of those just mainly because of the lower internal cost. And so, Mitch, I took you off so you don't have to be so self-conscious while you're sitting there when I'm talking. But the goals here are that, what are the different types of assets? Obviously you got stocks, ETF, mutual funds. what we want to focus on today is really talking about just using mutual funds and ETFs as we go through the day here. So then and we've got up here non-qualified and qualified. I don't know why stocks got off of non-qualified, although I guess maybe Mitch put these screens together, and the idea is that maybe you don't have the same amount of tax efficiency with the stocks that you have. Maybe that's why it didn't get on the non-qualified list. But oftentimes the bigger parts of the money are over there, and it is over on that side of the equation to be able to run it. And then trading frequency, he's got me really confused. Daily, I guess if you use the global equity 4, we have one daily element in there. But most of the time you want to stick to the weekly.
Right.
So do you want to defend yourself, or?
Do I want to defend myself? So, this is something that we've talked about in the past. And I know Bob and I will go back and forth a little bit on the stock side. I will always defer to you, Bob, when it comes to the structure. But this is really just a guiding framework as far as when it comes to building out these portfolios and then looking to deploy these portfolios within your practice. You should be able to have something that fits each of these different sides of the tax structure. And yes, there is some consideration that pops up at times as far as tax efficiency. But all too often we've seen time and time again that advisors that are overly focused on tax efficiency, they end up giving back so much of the returns just because they're focused on the wrong thing.
Well, I used to tell everybody that came into my office, my goal was to create a tax issue for them. That means I made them money and they were going to have to pay taxes. So taxes are actually a good thing. They're not a bad thing, and it's just a matter if they take away too much. And at the moment, they're trying to get more and more, especially for the more affluent, obviously. But we still have a long-term capital gain and those type of issues that are handy there. Let's see if we can go to the next screen here. I'm not sure what screen we're on, but I think this is it.
Yep.
We're talking about we're going to talk about the premier portfolios, and there's a couple ways to look at it. There's an all-in-one, which would be like our all-weather ETF fund, and then we have sleeves, which would be global equity sleeve, maybe. Do we have a list of them here? Did we
on the subsequent slides.
We go.
Yep. So a good way of summarizing these types of portfolios, the all-in-ones are the portfolios that it's just that. Everything has been put into this portfolio to cover a variety of different spaces.
So for instance, just to butt in, for instance, on the all-weather, you have a large, mid, small, value, and growth. So it's kind of a dynamic. I built this thing way back in 2000. Originally with mutual funds, and now we've got an ETF version which actually does a much better job than the mutual fund, primarily because it has much lower cost embedded. But the whole concept was to have a large, mid, small, value, and then growth, and then embedded a short-term bond and a long-term bond to, like it says, make it all in one, so it's going to allocate to where it needs to be. So like in years like last year, it was allocated virtually 100% most of the year to the equity side. This year, it's more balanced. It's we've got equities and bonds. And go ahead, Mitch. So
these different portfolios, I've listed 3 just for examples. The all-weather ETF, the global equity strategy, the tactical allocation strategies. Each of these were designed so that if you wanted to, you could pick them right off the shelf. You could deploy capital into it, and it would be perfectly appropriate for just about anybody with the classic 70-30, 80-20, 90, so on down the road in risk tolerances, because it fluctuates depending on where we're at within the market cycle, how heavily aggressive it is. We've done the risk-reward charts on there, looked at the efficient frontier, and seen that most of these portfolios, what would you say, Bob? They typically match up around 70-30, 75-25, somewhere around that for...
On balance, you mean over time?
Yeah, over time.
I think over time, almost every strategy we do ends up to be about between 60 and 70% of the time we're invested, in the balance we're in some cash. So what that means is we're always playing some sort of defense, and on occasion we're pushing it all the way where we have 100% of the money working. And I believe the next couple slides we'll talk about some of the sleeves
Right.
and what they look like and how to combine multiple strategies to deal with suitability. So on the S&S side, suitability and scalability, we're going to talk about the ways that you can actually build the practice out so that you have a good understanding of what everybody has. Matter of fact, not a good understanding, but an exact, you know exactly what assets are in different groups of folks. Because what we suggest is that you categorize your entire practice. I actually think there's only 3 types of clients. Some people might think there's more, but in my world there's 3. And I think you can authenticate that with, I believe we're going to go through a 2-sleeve or a 3-sleeve process to be able to authenticate that entire suitability and match some of the goals and what's appropriate for these folks to do.
Yeah, just one last note about the all-in-ones. One of the reasons why I love them so much is they're just so incredibly simple. I mean, there's really no way to mess it up, because what you see within the VPM framework within 2.0 is what you should be seeing in each of your client accounts. So there's no confusion as to how heavily invested you're at. You can see, looking backwards in time, how the strategy has performed, so it should match up exactly with your client accounts. Maybe there's a tiny bit of slippage when it comes to the execution, but really you should be spot on when it comes to performance, which is different from the multi-sleeve approach, whether it's 2-sleeve or 3-sleeve. Now, of course, the advantages to the sleeve is you get more concentration in each of the different sleeves. Now, what we mean by sleeves is instead of having one portfolio like the all-in-ones that have a little bit of growth value and some bonds and maybe some other areas, whether it's emerging markets or real estate or any of the classic asset allocation type components. On the sleeve side, what we're really doing is we're drilling into that one component. Some advisors will refer to them as like core and explore or core and satellite type strategies. And what defines the core will vary depending on the suitability of the client. It could be that the core is equity based, it's 100% equity. Or it may be that it's a combination of equity and bonds. And so when we mean sleeves, it's the different sleeves that go into addressing the total needs of the client based upon their suitability. And so what we have here is a couple of different examples. We have the core equity or the global equity strategy, which is essentially the domestic blends of the small, mid, and large cap markets. We've also tossed in the emerging market space, as well as the foreign, the MSCI index, an ETF version of that. And so it gives you a pretty core equity global approach to investing. Now, an easy way to be able to temper that down depending on their suitability and risk tolerance is by combining that with something like the global bond strategy, which has a few different bond positions in there to help reduce the amount of exposure on the equity side and still have that rotation within the bond piece to be able to participate in the bond market as it's playing out currently. So we also have an example on there, the core equity strategy. What that was designed to do is to rotate around the different sectors, the domestic sectors. I think in the Premier portfolio that we're using 11 different Vanguard sector ETFs. So it truly is a sector rotation. So if you take that strategy and marry that with a bond strategy, you have a nice domestic equity strategy with also a global bond strategy in that. And these are just examples. We're picking on the Premier portfolios because they're basic strategies. I think, Bob, you've referred to it in the past as the greatest tasting vanilla you'll ever have.
Yeah, as far as like something like ETFDI, because it's just a generic strategy. But it's interesting because we've went through a SQL command to see what everybody has built, and everybody has basically ETFDI, sometimes with an alternative, gold or REIT or something like that, like Mitch was just talking about. And then the last phase is maybe there's a more aggressive alternatives, but for the most part, everybody owns and models the same symbols throughout our database. When it comes to ETFs, there's probably fewer than 20 overall, and then they're concentrated in probably the top 10.
Yeah, I'm not sure what the exact breakdown, but certainly the top 10 positions are made almost exclusively of ETFs, and Apple and a few individual stocks, but it's almost all ETFs, and it's the same ETFs, representing that space. Even though you as an advisor have the ability to subscribe to our Premier portfolios, we've seen so many advisors create their own versions or variations of the Premier portfolios where they're using the same building blocks, but they're tossing in one or two additional positions because, again, you're starting with that same basic framework, and then you're maybe dipping your toes into one or two other areas because of either some search for alpha or because of suitability. You're tempering it down with maybe some other bond positions.
Mitch, let's go off to New York Stock Exchange and talk
Okay.
a few minutes, and we're both visible now, so we can.
All right.
So you're not just talking, listening to us talk with a blank screen. I think there's several things along the lines of what we're talking about that we see. I don't know if we'll call them mistakes or variations that end up confusing what a lot of folks are trying to do. The reality is, most people think that you win by beating the indexes every year, and somehow that's how it works. And really what you do is what the whole VPM strategy is, stair-stepping this equity over time. And it's about not losing when the market's going down and participating when it's going up. It doesn't, and the beauty is when there's the losing periods of time, which always come around, then you get the opportunity to really flatten out the overall volatility of the equity in the account, but meanwhile still stepping it forward. So we're going to bring up a couple live screens here in a minute. I'm just looking through so you folks don't have to see what I'm switching around here. But there's a screen here that we're talking about, and it's called the perfect portfolio doesn't exist. It's like perpetual motion. You can't actually do it. You can get some pretty low friction environments, but there's always going to be friction, and there is no perfect portfolio. And really what we have built the entire business, I have built this business on, is really being able to stair-step this equity, to participate. We always use participate, protect, and grow. You want to participate when appropriate, you want to protect when necessary, and you grow the assets over time. So the deal is, if you can come up with a 7 to 9% compounded rate of return, guess what? You just won. And that's over any market, up or down. When you start to look at 3 and 5 year rolling windows and maybe 10-year windows, that's your goal. And if you do that, you're going to double folks' money from the time they walk in. If they give you somewhere between 7 and 10 years and you double their money, you've done a pretty good job. That's what they're hoping for. They walk in your office hoping that at some point when it's retirement or some point down the road, they've got more money than they started with. They didn't walk in trying to, gee, I hope he can beat the S&P. Because the S&P, as we know, we had a whole lost decade where there was no money to be made. And just simple as taking looking at our S&P, the PPG 500, we over doubled the money during the 10 years when the stock market was flat. And we did that through balancing the risk and participating when the markets were going up. So it's a cumulative effect of winning. I think Mitch and I were debating. I thought I said that we would have the trade impact chart today. We don't, but we promised to have it on Thursday. But it does really show this particular aspect that I'm talking about. I'm going to go back to Mitch and I disappearing and go to a couple screens here so we can ultimately get to the next level of being able to talk about building custom portfolios and all of those things. We may be beyond any real reality of being able to do this in this particular space that we've carved out, but we'll go ahead and give it a shot. One of the things in the review of your practice that is important to understand is what kind of account size, what your average account size is. And if you're utilizing ETFs and mutual funds, you can probably go down to a pretty small account size. Most folks we see, maybe 50,000 is small, but for the most part they're 100 plus, and those type of things work pretty good. If you have too small of an average account, you probably don't want to try to have an equity account and split some in equities and some in in ETFs or mutual funds. One of the craziest things from my viewpoint is when we see people trying to slice the pie up so many ways that ultimately you've diluted the probabilities of actually doing anything good for a client. When you got the alternatives, we see, putting into insurance products, and you slice it all up, you got 10% here and 5% here and 20% here. And in the end, what you end up with is just a big bowl of spaghetti. I think Mitch has got some scenario about the when you mix if you go to the salad bar, there's certain things that are appropriate to put in a salad. If you put the wrong things in a salad, it doesn't taste very good. And that's what we see a lot of advisors doing when they start to try, because this diversified thing is stuck in their head. They think they have to do that for compliance reasons, to demonstrate to the accounts that they're doing things. And in the reality is they probably don't care about that as long as their money's growing. I had a guy tell me probably in about 1985 or so. I was telling him about all the stuff I do, and he was from Memphis. I remember he had a little country twang, and he goes, "Son, I don't give a damn what you trade, just make me money." And that's pretty much how customers do. They care as much about what you're doing as the result, and the result is really what it's about. And I think if you can, the confidence in what you do for your clients comes through that appropriate messaging. So you want to be very, very careful that you're not over talking the diversification game, and to end up with some very mediocre type returns overall, and maybe doesn't match the expectations of the client. So there's some medium in between those 2 points. And I guess I always struggle when we have advisors coming in and they're talking about how all these different elements they put in their account, and they seem to feel really good about what they're doing. I'm not sure that they should, but they do. And because in the end, it really doesn't facilitate anything. I have my own issues, which I'll be nice, since you can't see Mitch at my face, because when I say what I'm about to say, he's gonna make it smirk. But I don't have a real high regard for annuities, but I have what I think they're really for. But we won't talk about that. There'll be some other time. But I think when we start to look at account size, number of holdings, this is what I'm talking about when you don't have too many of whatever. Because if you try to take and put, let's say you have a $250,000 account, try to put 100,000 in stocks and another 75 or another 100,000 in ETFs, maybe using a global equity strategy, and then there's some money going into something else. It just starts to get too convoluted, and it really doesn't start to build the goal. And I think those of you who've been around for a while know that the diversification is somewhat of an illusion anyway. And the concept that in VPM is really about is its concentration with a sell discipline is how you're going to really meet these returns, because you can't participate, protect, and grow if you're diversified to the point where even when you're participating, you're not doing much. We see 5% allocations to commodities or something. So if you made 100%, you'd make 5% dent on that. You'd do better off if you owned Netflix last year. Been a lot better investment, and it would have been more fun to talk about than some commodity trader that you don't know throwing around some stuff to make 20% on your 5%, which is 1%, which is kind of a joke in the end. But anyway, enough about that. But so what we're trying to do here is really getting you into understanding how to build these sleeves and how to make them happen. I think this is the next screen here. Let's see what we have next. Oh, summary, how fun. So let's go over to, let's actually bring up.
Well, just one note on that, Bob, just toss in a couple things. And yes, in another life, I did actively manage variable annuities. So I do have a background in doing that. I know some advisors have been successful in modeling some of.
Oh yeah, I'm not saying you can't do that. It's the upfront.
There's better frameworks. I guess doing the wrong thing right.
Yeah, it's just the upfront payments that bother me. Anyway, let's take a look at some of these premieres. We've got up here that we brought up some of the sleeves, and I don't know if we have a real good illustration for this meeting, Mitch, to be able to show how these things are going to be blended. Do we have anything that we have together?
No, with the technical difficulties we have today, it's not going to work.
Yes, it's not going to work. So, but one of the things I think is important. It's interesting that I'm just bringing up our good old bond DI here. I'm going to make this screen get sort of works. See if I can move this over a little bit so we can see everything. But it's interesting that right now, of all the active, we are 100% long bonds. And what continues to happen, we had a wonderful day in the market today with it getting clobbered again, but we're seeing interest rates continue to be buoyed and be bullish. So one of the things that Mitch mentioned a little bit ago was actually the all-weather strategy. Taking a look at that real quick here. Let me bring that up. Sure glad you folks can't see me. You see me squinting my eyes at the screen here.
You don't have your Poindexter glasses with you?
I don't. I forgot them. Let's see here. We want the all-weather. And the all-weather is right now, the positioning of this is I guess interesting from the standpoint of open positions, and this kind of illustrates what we were talking about. We've got the bonds, and we have the intermediate bond, and we have some value that's left on the books right now, which when we look at the summary sheet of this, we're looking at 50, basically 55% invested, and we've been talking about these portfolios and how they've been responding over time. Now, this one had an incredible year, up 30-some% last year, and off a little bit this year. But the bottom line is, this is more of a. It's actually a little bit more than I guess from a percentage standpoint, the way you're being positioned. But one of the things that we want to talk about is taking these multiple positions and using these sleeves, using the strategy as a sleeve. Why don't you discuss a little bit of that, Mitch, that we're talking about there?
Yeah, so with the all-weather ETF portfolio, that's a great example of a beautifully operating all-in-one portfolio. And the reason why I think it's such a great example is just with the activity that we've seen just in the last 12 months alone. If you looked at the positions that we held 12 months ago, you'd see that it was all equity based. I think we were long every single equity position. We had the small, mid, and large cap, both the growth and the value, and we didn't own any of the bond components at that time. And that remained true up until about the beginning of this year. The end of last year, I think, is when we first started taking on those bond positions. And now you see that we've rotated out of it. And now, yes, we are 50% invested, but even if you dig into that a little bit more, you'd see that one of those holdings, one of those three holdings, is actually a bond position. So we're even more defensive than a classic 50-50 type blend. So that's a great example of a strategy that fluctuates in its exposure to the market, as well as to both the equity market as well as the bond market, depending on what we're seeing taking place in those equities. So it's a very nice dynamic strategy that moves around the classic style box to be able to participate in the equities that it needs to, and then also bringing in those bonds. And you can see on this chart that Bob pulled up how it has just trounced the S&P 500. So it has the same elements of something like the S&P 500. It's in a very simple to explain, easy to understand framework that I'm sure if you were to present this strategy to any of your clients, they'd understand it immediately, because they understand owning the style boxes. They understand incorporating bonds at times for their portfolio. So it's a very simple strategy to explain and sell to your clients, and it's also a very simple strategy to run in a practice, because we're using those ETFs. There aren't a ton of trades that need to be placed throughout the year, because it's just those 8 positions, and it's operating on a weekly basis.
Yeah, and you can see just from looking at the performance done really well. So this is the all-in-one. So if you start to look at sleeves, let's take a look at the different sleeves here. So now we can go to like Global Equity 4, and you can start to take and use your equity side. So you have a 60-40. You can put a 60% of the money into the Global Equity 4, and then if you can put 40% into the global bond, let's say, and their sister strategies, and you'll be able to take that 60-40 account and do pretty well. Back in '08, which everybody tends to measure risk and how well you did, that 60-40 strategy was minus about 5.6%, and in 2009 it was plus, I think it was 23 or 24% in the combo, even though the Global Equity 4 in '09 was up 30. By putting the bonds in, you tended to bring the mix down a little bit, but that's what's expected. You're supposed to be bringing the relative risk down to that point.
And again, depending on the risk tolerance of the client, you could blend that differently, whether it's 60-40 or 70-30. Even then, I'm still a little hesitant to say that you should have a 70-30, 80-20 blend of each of these strategies, because what you're doing is you're beginning to make it sort of daunting when it comes to the scalability side of things. Unless you have a lot of clients that fit that particular framework, I wouldn't be quick to offer blends of each of these at different levels, unless it's something easy to do when it comes to your custodian and it makes sense for your client base. Typically, if you really look at the performance on something like a 60-40 or 80-20 or 70-30, you'll find out that there really isn't that significant of difference because of the downside protection that VPM offers when it comes to running these portfolios. And so what you may do is create a lot of activity within the practice to try to force some sort of MPT type mindset on something that's far more active than modern portfolio theory is accustomed to. And because of that, you've created additional activity, but not seen any real accomplishment within the returns or the results within your practice. So that's something that I always caution advisors on when they start going down the sleeve approach. Just because you have the ability to blend different sleeves, you want to make sure that you're doing it in a sensible way for your practice.
Okay, let's go ahead. Matt, you can drive if you want to show some of these other strategies.
Yeah, one of the other ones I think it's at least worth touching upon is this core equity sector. We get this question asked on occasion. What do I need to do to be able to have a sector rotation strategy in place? And so what you can do, I'm trying to click on it right now.
Not working?
Not working. Go ahead and click on the Premier Core Equity sector if you could, Bob.
Okay. Of course, it would only be par for the course that you can't.
Yeah. It's building character, right?
Yes.
So you see right now, again, taking a look at it, you see that we're 50% invested on the strategy. So of the 11 different Vanguard sector ETFs that we're tracking, we're only invested in 4 of those positions right now. So this is another example of an equity sleeve strategy that you could utilize, where on the domestic market you're deploying assets in a different framework. Instead of being focused on style boxes, you're being focused on the sectors. And so it's breaking apart the same investable market on the domestic exchanges, but we're doing it with a different focus, in this case sectors. And like we've talked about before, we've seen this done in a lot of different portfolios. Even though we already have this built out, again, we're using the Vanguard ETFs for this strategy, but it's certainly something that we've seen a lot of advisors do. We had a slide about this earlier, and we've also talked about this with advisors as well, that with the advancement of a lot of these non-transaction fee ETFs, a lot of custodians are putting out various different flavors of these same ETFs that they could use within their practice without incurring any transaction costs. And so while we have talked quite a bit today about these premier portfolios, the main reason why is because they're off the shelf. I mean, it's just something that you can pick up and run with from day one. So there's this one advisor that Bob and I, we always joke about. internally where he stopped me and he said, Mitch, I don't want you to tell me how the watch is made. I just want you to tell me the time. And for that advisor, it was the greatest way to communicate. What he really was looking for was something off the shelf. He just wanted something that would work for his clients. And that's really what these premier portfolios are. Now, in his case, he's actually clearing through Schwab. And so after some additional conversation, we found out that he had some non-transaction fee versions of all the same ETFs, the same securities that we have within the premier portfolios, but at a lower cost to both him as well as the clients. So I'd say, if you have a custodian that has these non-transaction fee ETFs or non-transaction fee mutual funds for that matter as well, it's worth taking a look at what those lists are, what those securities are, and see if they're comparable performance. And then when it comes time to place orders, let's say you're matching something like the Premier All-Weather ETF strategy. When it comes time to deploy that within your client accounts, just go out and grab the non-transaction fee versions of those ETFs instead of using the ones that we're calling for. Still follow the signals, but use the securities that aren't going to have any sort of transaction cost on it.
Okay. Yeah, Mitch, I'm going to bring us in live. We're in a new setting. I've been playing while Mitch was talking. I've been playing with the video settings, trying to get something that you can see us. I hate having you folks listening to this talking chart or whatever. Yeah, I think when as we're winding down today, we're going to be better focused. Hopefully, better. We're prepared, but with all the little technology glitches that are going on, that it's been somewhat frustrating for Mitch and I anyway. But the bottom line is, building a good practice around what we do is a lot simpler than a lot of folks think it is, and sometimes it seems too simple. But when you start to build around these sleeves, some of these pre-built, it's a good place to look at. And Mitch, correct me if I'm wrong, don't we have a bunch of those NTFs? We've already rebuilt them to match up some of the premiers. Don't we have some of that stuff done?
We have, and that's something that we're going to be putting out. I think we're going to be putting out through the premier subscription side. But we have already done all the legwork to match those up at the different custodians.
Yeah, so we rebuilt ETFDI and ETFDI4, all the ones that we could, at different custodians, by the way. So we have a Schwab version, we have a TD version, we have a, I don't know, do we have Pershing?
I believe we have Pershing as well.
Okay.
There's 4 different custodians, and I'm blanking on what all 4
Fidelity is the other one.
Fidelity.
So we do have Fidelity as well, I know that. So yeah, so we've tried to put this legwork together. It does present a much lower business model for you folks from a transactional standpoint, as well as there's even benefits on some of the internal costs on some of these ETFs as well. And often case, they're exactly the same ones. They're BlackRock, whatever, or iShares, whatever.
Right.
So it's not like, and in some cases it might be the Schwab, whatever, some internal fund that they run. But anyway, those are pretty good. I wanted you guys to see what Mitch looks like in the desert with a sweatshirt on.
It's a sweater.
Yeah, sweater, sorry. But anyway, I think we covered some pretty good material today. Once again, please, we got a couple emails which we plan on covering on Thursday. We're going to do for sure the trade impact chart, and let me see if I can get us back here, back in the New York Stock Exchange to finish. But for sure, we're going to do the trade impact chart. We're going to get some very specifics and walking through and utilizing the wizard. And then the following meeting next week, so next Tuesday, I want to force it to getting to the point of talking about maintaining these strategies. So at least for the moment, we're just going to kind of jump around. We've got some questions that come in, and we're trying to formulate some of these shows to answer some of the questions in the field, because the nice thing about all the premiers is there is no maintenance. We take care of anything that will change on our end. All you have to do is follow the bouncing ball, put the orders in, blend them, do 60, 40, 70, 30, whatever with the different sleeves, and you're there. Or we have a lot of folks that just use that all weather and just let it be what it's going to be. So it's more of a dynamic situation. And as always, which most people tend to forget, is that cash is a position and it is an asset class. And it's a good asset class. It's the only riskless asset class that there exists. So you can hedge an awful lot of risk by just going to cash. You don't have to do anything fancy. I think we talked about on a Market Thunder show, or maybe even the previous show, and talking about philosophy, that there's a lot of things you can do that will get you to lower risk, relative risk to how you're exposing your clients and different elements of time. And sometimes conservative is good, and other times you want to be aggressive, and BPM does a pretty good job. We're continue to, just a final market note, just on the activity that we saw today. We continue to see the markets stay under pressure, and we've got just a couple minutes to go, and the Dow Jones is trading back to where it was yesterday morning, down about 129. S&P's at 1867.81. So you can't seem to get 2 days in the same direction. You can't seem to find a reason for people to own the market, and we're sitting in average 57% cash. I feel pretty good about that. I think you folks should too. You're not missing anything on the upside for sure, and you are missing the potential of how this thing ultimately resolves itself, is that we see a fairly sustainable decline sometime in the next couple quarters. I've been talking about, I think this quarter has the highest probability that the market makes a high. So we will see you folks in the morning at Market Thunder, and that show's a lot better organized, and we got a lot of work to do before Thursday. So we had sort of fun. Hopefully it was informational for you guys. It was. We'll probably have a better laugh once we're off air here in a minute. But
Yeah.
we really appreciate the folks that stayed on and hung with us. One of the internal folks was texting a minute ago saying it was one of our better streams, which I question that, but it's okay. I'll take it. I'll take anything I can get at the moment. But anyway, folks, thank you so much. We're trying to make this fun, informative. You folks getting to know who we are, and to find out a lot of these little thoughts that you have. And if you're streaming this and listening to it, hopefully if you see this before we come on in the morning, tune in the morning. It looks like the markets are actually, the futures are punching new lows out as I speak, right into the close of the day. So we just saw about 100 points of selling coming into the futures. So anyway, thanks again. We'll see you in the morning. Have a great rest of your days, and we'll talk to you later.